So today, let's dive into what looks like a classic corporate comeback story, ASL Marine. We're looking at a recent analyst report that suggests this company might have gone from just trying to stay afloat to potentially entering a whole new era of growth. It's that surviving to thriving narrative that investors are always looking for.
Whoa, okay, hold on a second. A 335% jump in 1 year? That's massive, but it also kind of screams too hot, too fast. So the real question, the one every investor has to be asking, is this. Is this recovery built on something solid, or are we just looking at a temporary sugar rush? We really got to dig in to see if there's more fuel left in the tank.
That's a fair question. So let's start with the bull case, because the argument for optimism here is actually pretty compelling. According to this report, it's really built on two solid pillars. And the first one, well, it has to do with their core business of ship repair, which is catching a huge tailwind right now.
And this right here, this visualizes the opportunity perfectly. What you're looking at is the age of the global shipping fleet. See how that stack of darker colors is growing? That means older and older vessels out there on the water. Now, for a ship repair company like ASL Marine, older ships are fantastic news. Why? Because they need more work, more complex repairs, and higher margin jobs just to stay seaworthy and compliant.
And it's not just about getting more repair jobs. The jobs themselves get more valuable over time. The report points out that when a ship hits that critical 15-year mark, it needs a special survey, and the amount of work required for that survey jumps by about 20%. That means more revenue for every single ship that docks in their yard. It creates this really stable, growing stream of high-quality income.
Now, the second pillar of the bull case is all about stability. ASL has locked in 82 million Singapore dollars in long-term chartering contracts. And these aren't for some speculative projects, they're tied to huge infrastructure builds like Singapore's Tuas megaport. This gives them a really defensive earnings base with clear visibility for years into the future.
So when you combine those two things, the recurring high-margin repair work and that super stable charter income, you get this really powerful earnings trajectory. Just look at the forecast. Adjusted net profit is projected to double from $18 million in 2024 all the way to $36 million by 2028. You can't argue with that trend.
Okay, I'll give you that. The growth story is compelling, and that trend line looks great. But a fast-growing company can sometimes hide some underlying issues. It's not enough to just look at the profit. You have to ask the tough questions, like, how are they financing all this growth?
Exactly. Any smart investor knows you have to kick the tires and look at the company's financial foundation. And for ASL, that means we absolutely have to talk about debt. For a long time, this was a huge problem, and that kind of shadow doesn't just disappear overnight.
And yeah, this is the number that makes a skeptic pause. A net debt-to-equity ratio over 200% for 2024? That's high. There's no way to sugarcoat that. It represents a lot of risk. And this is a big but. The key story here isn't just that one number. It's the trend. Look at how quickly that's projected to fall. They're deleveraging at an incredible pace, dropping to a very comfortable 7.6% by 2028. So yeah, the starting point is high, but the direction of travel is exactly what you'd want to see.
A fair point on the debt improving, but that just leads me to another big question. If profits are growing strong and the debt is coming down fast, there's another number that just doesn't quite add up: the valuation. The report makes it very clear that the stock is trading at a 30% discount compared to its direct competitors.
And that's really the heart of the whole debate, isn't it? The market is clearly still a bit cautious, and it's probably because of that debt history you just brought up. It's a classic case of a company's performance improving faster than its stock price is catching up.
Right, and that disconnect is where the opportunity, or, the risk, really lies. So let's take a look at what could actually close that valuation gap, and what the future might hold. We can start by putting that discount into clearer terms.
So this slide really breaks it down for us using a key metric, the price-to-earnings ratio, or PE ratio. Basically, it's what investors are willing to pay for every dollar of a company's profit. As you can see, ASL is trading at just 8.9 times its forecasted 2026 earnings. Its peers? They're at an average of 13 times. The bull argument is pretty simple. As ASL keeps proving its recovery is for real, that PE ratio should climb up to match its competitors.
So, what's the roadmap to closing that gap? Well, the report lays out a pretty clear three-step journey. First, they've got to keep paying down that debt. Second, they have to keep delivering on that profit growth. And third, and this is a really big one, they need to start rewarding shareholders directly.
And this is a huge signal to the market. After almost 10 years, ASL has started paying a dividend again. A company just doesn't do that unless its management is extremely confident about its future cash flow. It's their way of telling investors, hey, we believe this turnaround is sustainable and we're ready to share the profit.
Okay, but the report also mentions what it calls an upside catalyst. This is basically a potential bonus, an event that isn't really baked into the current forecast, but could give the stock an extra boost. For ASL, it's the possibility of getting back into building complex offshore vessels. Management is being cautious, saying they won't build on spec, but if a firm customer order comes through, well, that could be future growth that no one is pricing in right now. It's a nice to have, not a core part of the story.
So let's bring this all together. On one hand, you have a really clear recovery story that's driven by solid fundamentals. But on the other hand, you have a stock price that just hasn't fully caught up yet. So what should an investor actually be watching for?
Well, according to the report, there are three key things, three share price catalysts to keep on your radar. First, look for more contract wins. Second, any news that they're expanding their dry dock capacity would be a big deal. And finally, keep an eye on that dividend. Any increase is the clearest possible signal of financial strength.
So, after weighing the clear skies of the recovery against the potential storms of debt and valuation, where does the analyst land? The conclusion is pretty straightforward. They're maintaining their buy rating on the stock.
And they've put a target price on it of 35 Singapore cents. Now that suggests there's still significant potential upside from here, which shows their belief that that valuation discount will eventually close as the company keeps executing on its plan.
And all of this leaves us with the final question, really. All the evidence points to a company that has successfully navigated some very rough seas and is now charting a new course for growth. But the market is still offering it up at a discount. So for any investor, the question is simple. Do you believe this is the start of a much longer, more prosperous voyage?